So welcome in, y'all. Good to have you here. I won't keep you long, but I do want to go over a couple things with you that I think are kind of cool. Some of you have already done your final exams, and they look phenomenal. Watch this. I think everybody can see my screen. Well, where did it go? Unbelievable. Where did it go? The final exams were here. But anyway, everybody's doing really good on the final exam, which is good. You shouldn't be worried about that. Just relax. And apparently my internet is slow or it would be showing all of that. But what I wanted to do also is show you, as we're talking about investments and different things, Tom, the Ray Dalio all-weather portfolio, right? Here it is. Look at Katherine's plan here. Isn't this great? Invest in a retirement, plan of action to max out a Roth IRA annually, pay off student loans, make monthly payments plus extra, pay off my car loan plus extra, become more risk averse, expand my investment portfolio, increase my savings, save 10% or more of every paycheck, buy a home. So she's going to save 10% of each paycheck for a down payment, create an emergency fund. She wants to save up to 3 to 6 months of living expenses, contribute to 3 charities aligned with my personal values. You can do it. She wants to also get a dog, paint more, travel the world, move to the East Coast, and anything worth having takes time. Isn't that great? Oh, she did good. And then let's see if I can get this one up. The Ray Dalio all-weather portfolio, Tom, do you recall what was in that portfolio?
Well, not off the top of my head.
Michelle, do you remember what was in the portfolio?
Yeah, it was stocks, bonds, I have it written down, commodities.
Okay, stocks, bonds, commodities. What else?
Gold, I think, was the other one, wasn't it?
Gold.
7.5% commodity, 7.5% gold, something like that.
Okay, something like that. So if I told you, Michelle, put stocks in a portfolio, how would you do it?
Put stocks in a portfolio?
Yeah, how would you buy a stock fund, or you put individual stocks in this all-weather portfolio?
Fund.
Yeah, fund. And what would be a name of a fund that you would put them in?
The Vanguard Total.
Yeah, the Vanguard Total, which is VS
STAX, right?
Yeah, VSTAX, I think. VSTAX, maybe. Or if you wanted the S&P 500, you could do VOO. That would be fine too. Bonds, what fund would you put in if for the bond portion of this?
There's the total bond portfolio that Vanguard has.
Yep, yeah, and I think it's TLX. I think is the total bond fund. Okay, now I'm going to trick you up a little bit. If you wanted to put gold in a portfolio, how would you do that?
I think there's a thing for it. I don't remember. It's one with GLD or something.
Yeah, there's a kind of an ETF, a Spider Gold Trust GLD, right? That you could put in there. Let's kind of see what gold's been doing. Gold's been kind of wacky of late. Let's say gold has been up, up, up. Look at this. So they could buy shares of GLD. Now, you can get a little more complicated when it comes to gold, and I don't want to freak you out, but there's a future for gold as well. It's called /GC. That is the future for gold. But you see, it is $23,000. If you buy the future, it's going to cost you $2,346. That's why a lot of people try. And there's micro gold as well. I think you can do micro gold, MGC. Yeah, micro gold futures. But I think for most of you and for most of your people that you were working with, I would say something like gold. All right. Well, let me ask you another question, Michelle. You did good on that. What would you do if you wanted some commodities?
There's a thing for it. I do not remember what it was.
Okay, but y'all know how to look things up, right? And when you're looking up these different things, like you could do, let's say we wanted to get some oil in there, right? USO, what is USO? USO is United States Oil Fund, right? That could give them some oil exposure. Different things like that. There's actually, as well, there's /CL, which is the crude oil futures, right? But there's different ways to do that. There's soybeans, SB. I think it's SB. Hold on a second. /SB. What is this soybean? Maybe it's not soybean, but what are the soybeans? I haven't traded them in so long. You could do the British pound, /6B, Australian dollar futures. I mean, there's all different kind of things of all different things that you could do. God, I'm trying to remember what the soybean was. /S. Here we go. Micro silver. You got silver futures. You got all kinds of things. What was corn even? I can't even remember what corn was. But anyway, you could do corn, you could do wheat. There's all different kind of things out there that you could get your clients involved in. If you're comparing funds, what do you really want to look for, Tom? If you're comparing funds for your potential clients and you've got two potential stock funds or you got two potential bond funds, where are you going to direct your client?
Well, I look at risk and I look at historical data, how it's done versus the index that it's in, or the sector that it's in, how it does compare to the other.
And what else that's good. That's real good. You're on a good path. What's another important thing that you need to look for? I mean, this is like really important. Even in the books, if you read the John Bogle book, Jack Bogle book, the Simple Path to Wealth book, any of those books, what's one of the major things that we're going to look at?
The expense factors involved.
Expense, absolutely. Yeah. Expense ratio. So all things equal, if they're investing in the same thing, then you want to make sure that that the expense ratio is really low. And that's why I like the Vanguard funds, is because they're really, really low fees. So I've got my daughter, she's 19, and she's 100% of her portfolio into VOO. And some people would say that's probably too aggressive. I do not think so. She's 19 years old. She's got, 46 years before she needs the money. So she's doing well in VOO. So that's how you do it. All right. So I just want to make sure you know how to buy these funds. Now, I want to switch just for a second. Now that you kind of know how to buy those funds and how to get people in on, I wanted to show you something that I did back during the COVID crash. During the COVID crash, I knew that something was going to be wrong. I was like, I am really, really nervous about the market. And so what I did was I did some put-back ratios, and I just want to show you kind of what it looks like on the Thinkorswim platform. So here's what I did. I went into the S&P 500 futures, and I did a put-back ratio. I just want to show it to you, show you what it did. So here's what I did is I went and I said, okay, I'm going to go maybe 120 days out. So let's go with 112 or 128. It really doesn't matter. And there was a gentleman by the name, I'll give him credit, Ron Bertino, who came up with a specific putback ratio spread that would work well in the event of a black swan event. I had a feeling that a black swan event was going to come with COVID. And indeed it did. Let's look at what happened to VIX during COVID. Remember, VIX is the fear index. And you'll see here it is in 2020. VIX got up to 85. Ladies and gentlemen, VIX is at 16 today. VIX got up to 85. And I put on some putback ratio spreads in the S&P 500. So let's show you what it looks like, because I think you'll at least think that this story is cool. So you would sell 3 options that are closest to $3. So you go in here, 280, there's $3, there's 320. So you sell 3 of these, except that I sold a lot of those in groups of 3. 3 is a tranche. So I did maybe, let's say 27 of these. Let's say 30. Let's say that we sold 30 of these. Let's get that where I can figure out. Why is that not big? I want it big, darn it. I want this big. There we go. So you can see how many I sold. So I sold 30 of these. Now I want to show you what that looks like. I sold 30 of those, which means that I took in a credit of $4,415. Well, then this is 10 tranches. I bought 5, sold 3, and bought 5. So I bought 50 points below. So I bought the 50 of the 3,000s. All right, so everybody's seeing what I'm doing here. I bought 50 and I sold 30. That is 10 tranches of these things. So if you were going to just do one tranche, that would be sell 3 and buy 5. But I wanted to show you what it looked like after I did it. Okay, so to do this, it cost me $5.35 per contract. Now, there's you got to multiply that by X to get how much it costs. But let me show you how much this cost me. It cost me $2,775. Okay. Now, I knew that the market was going to crash, so I did this. Look at this. They only charged me $3,300 to put this up. So I'm buying 20 more puts than what I'm selling. Everybody with me? I'm selling 30 and buying 50. I want to show you what happened after I did this. Now, let's say that you, Michelle, and Tom are real nervous about the election. And let's say you're just scared to death that the election is going to it's going to be a disaster. Whoever wins, half of the country is going to be upset. The stock market's going to tank. So you buy this and pay $2,000 something before the election, a week or two, or the day before the election. You could even do this, right? And you're putting on this thing. Let's analyze this and show you what happened. Now, this is kind of cool. I think you're going to like it. So what it looks like, let me hide positions and only show you the simulations. And let's get rid of this so that I've just got the 30-50 on. Yeah, so let's show this. So what this shows is if the market dropped 20% in that night, I would make $23,000. Okay, well, that's okay, but it doesn't include volatility. So volatility would go up, and I'll show you what happened during the COVID crash. Volatility, I said, went up to 80, right? So I'm going to show this, go to vol step, which is volatility step, and show 4 steps. And I want you to look right over here in this little box. Matter of fact, let me draw you, see if I can draw a box over there. See if I can draw a box. Yeah, this is where I want you to watch. Okay. And so what I did is the market went up, volatility went up to 80%. I just want to show you what that looks like. So this is volatility being at 54%. It went up to 80. There's 74. Let's put it up to 20. Yeah. All right. So let's get this all together. So this is if the market fell 5%. This is if the market fell 10% or 12%. And this is if the market fell 20%. Okay. Now, Tom, Michelle, you're about to get happy, okay? What happened is it cost me $2,000, but how much money did I make? I made between, keep in mind, between the 74 here and the 94, I made just on those 5 tranches, $323,000 to $450,000. Yeah, that ain't bad. Now, the market actually went down further than this. The market was down, I think it was 35%. This is 20%. So let's move this little price slice down to 35%. And let's see how much we actually made. 4, 35. So now let's go find the thing. So during this entire period, volatility scrunched up to 35, or the market went, I think it was a total of 35% down, and we went up to 80% volatility. On a $2,000 investment, I was or up between $500,000 and $600,000. Let's find that place again. There it is. $505,000 to $636,000. So what I'm actually showing you is a way that you could, with a very small investment, if you think there is a black swan event possibly coming. And if you'll remember, when Donald Trump was elected in 2016, the market tanked the night of his election. It just tanked. Now, it recovered quickly. But if you've got a binary event like that and you think it's going to move the markets, you could spend a little bit of money for a potential windfall. This is kind of a lottery type thing. But isn't it amazing that something that would cost you, let's see what the cost was again, could make you perhaps $600,000. Confirm and send, it would cost me $2,700. Okay, so let's say that you do this, and then what happens the next day? Let's say that the market doesn't crash, right? It doesn't crash. Then all you got to do is get out of your positions. You would buy back the 30, right? And you would sell the 50. Now, are you going to lose a little bit of money? Yeah, there's going to be slippage. You know, the volatility went down from the event. You may lose $200 or $300. So you could actually close this position, but knowing that for maybe a $200 or $300 or $400 or $500 risk, that you could put something up that would potentially get you, and can you imagine if you did 60, 100 of those? What if you doubled those? You're talking about in one night, ladies and gentlemen, you're going to put, $1 to $1.2 million in your pocket for a $5,000 investment. Michelle, how you feel?
That would be awesome, but I don't I don't know that I could do that.
Okay. Tom, how you think about it?
It's a good day's work right there.
It's a good day's work. And I'll tell you the story. You've probably already seen the story when I was doing that Rising Star interview, but I was at the doctor's office. I had an infection in my toe, and the doctor told me, listen, we need to take you back to surgery. We need to cut your toe off. And I was in the waiting room, and it said no cell phones. And I said, Doc, if you don't mind, the market is crashing today. My hands were shaking. I said, I need to close some positions. He says, oh, my God, absolutely. Use your phone, close your positions. He said, I'm sorry you've lost so much money. And I said, au contraire, Doc, au contraire. I said, just the opposite. We are up a lot today. So isn't that cool?
That's great.
Who's got questions on that?
I have a question.
Yeah.
So you said if it didn't happen and you need to get out of it, how would you sell the buy the, like, is it just closing it, or is there like?
Yeah, it's closing it. What you would do is go to your shorts first. I would not close the longs first. I would close the shorts first. So you would close those 30. You would actually go to your monitor tab, and let me get that off. Go to your monitor tab and look at all your positions here, and you would find where that position was and right click and go close position. Or you'd find it on the trade tab. Go over here, and it would show you that you had a position here, and you would right click, and instead of buy or sell, it would be close, and you would close that position. So what I would do is on your paper account that you guys have now, I would at least practice how to do this. So here's what I want you to do. Go out 120 days. I want you to go to the one that's $3, sell 3 of those in combinations of 3, and then hold your control key down and buy 5 that are 50 points below where you sold those. So control key, buy that, and you can do it as a single order, and then make those 5 to 3, 4, 5. And then you go confirm and send. It's going to cost you $302 for one tranche. They're going to cost the collateral. In other words, you need to have an account that at least has $363 in it to do this. Okay. So it's going to cost you $332 and then hit the send button. And then maybe the next day, I want you to go in and find your positions here and then close them. Let me show you how on another platform, because I don't have any current positions here. But it would be like I would go trade. I'd go to E-minis or micros where I've got a trade. And what's this? It'll show you where you got positions, right? So in other words, here, I've got positions here. I've got longs here and shorts here. So you right click on that, close position, close all 7 of them, and then you would sell those long ones to get it back, and you would buy these short ones to get it back. Sell these, buy these. It's really easy to do. And then you may have to move your thing around to make it less advantageous. So, for example, I'm selling these, so I want to get as much of a credit as possible. So if I did that for 80 cents, it may not feel. So then I'd replace that order and do it for 75 cents. In other words, instead of me selling something for 80 cents, I'm making it less advantageous for me and I'm selling it for 75 cents. If that doesn't feel, move it down to 70 cents and eventually you'll get filled.
Okay.
But I just want y'all to know that, especially in election years like this, when you've got half the country that hates the one president and the other half of the country hates the ex-president, and everybody's going to be ticked off, and you go, it's like, think about you are holding a bottle of Coca-Cola, and normally that bottle is just, there's nothing wrong with it. But you keep shaking that bottle and shaking that bottle and shaking that bottle. That is volatility. Oh my gosh. And as that volatility swells, those options that you sold and bought that are the size of an apple all of a sudden become the size of a watermelon. And that's what happens. That's why those swell up and that you're making so much money on a one night stand. So what you could do is y'all even, maybe we could all get back together, a week or two before the election and say, hey, let's put some of these on and let's see what happens. And hopefully there's volatility going into the election. Be very cool. All right. Any other questions?
No.
Okay. That's what I had for you today. But I do want to look at one more. Mr. Shoemaker here comes up with his. He wants to retire at age 64. He's 10 years is his horizon and he's aggressive. Current asset allocation, 90% stock, 10% bonds. At retirement, he wants to be 70 stock, 30% bonds, which I think is good. He's got, and take all of these numbers as you play. I'm not saying that these are actual numbers or anything, but 401k, he's got 550,000. He's got a book of business at 605,000. After tax investment, 75,000. He's contributing 11% of his compensation, which is excellent, to a 401k. He gets an 8% employer match to the 401k. So he's basically putting up 19%. And then he tells you what his after-tax monthly investment is and his quarterly after-tax investment contribution is. His expected returns, he's looking to get 10% annually, and his projected balances looks like he's going to be very good for retirement. 401k at $2.2 million. His book of business is at $1.3 million projected in the future, and his after-tax investments are $608,000. He's going to rebalance his portfolio semi-annually, review his financial plan annually, have faith, trust process, and have fun along the way. I love it. He got 101 on his thing, and so did Catherine. She got 101 on hers too. So any questions about the final or any of your assignments?
No.
Okay. If not, I'll have a great week. We'll see you next Wednesday.
Thank you.
Bye, y'all.
Bye.